Assalamu alaikum listeners, welcome back to the new topic of financial accounting, which is a statement of cash flow. We all are very well familiar with the other two forms of financial statements, that is income statement and balance sheet. And also in regard to the balance sheet, we took the retained earning statement, which help us in calculating the ending balance of the retained earning to be presented in the balance sheet. Today I'm going to discuss how to prepare the statement of cash flow, and I will be using one of the method to prepare the statement of cash flow, that is indirect method. But of course I'll be giving you an summary of how to prepare the statement of cash flow using the direct method and the major differences between both methods. So our first learning objective is going to be number one, why the cash flow statement is made. So what is the usefulness of the statement of cash flow? And then we will be preparing the statement of cash flow using indirect method, and I will also do some analysis for the statement of cash flow. So let's start from our learning objective number one, which talks about the usefulness and the format of the statement of cash flow. So why the statement of cash flow is needed? Why do we prepare it? Because it tells us that what is the cash position or cash flow position of the company, or you can say what is the ability of the company to generate the future cash flows. If the company will be having enough cash, it will be able to pay the dividends, cash dividends to the owners, and to pay the money of the creditors on time. So it also tells us, the cash flow statement also tells us that will the company be able to pay the cash dividend, or can it meet its creditors expectations? Can company pay its obligations on time? Because if the cash will be there, then company will be able to do that. So cash flow statement gives you a clear picture of the cash position. Number three, why does the net income and the net cash provided or used by operating activity differs? In the initial chapters of financial accounting, you have taken the concept of accrued revenues and and expenses. Both of them you have taken it in the initial chapters of financial accounting. Accrued means payable, accrued expenses means payable expenses which are already incurred but you did not pay cash yet for them. Accrued revenues are those revenues which are already recorded but you have not collected the money from that revenue. So the journal entry would be accounts receivable gets debit and sales revenue or sales gets credit, right? So this journal entry does not have cash. But in income statement, we have all the revenues, we have all the expenses, despite the fact you received the cash or not, it doesn't matter. But once a revenue is recorded or it is eligible to be recorded, you will record it in income statement. If the expense is incurred, you will record it in income statement, even if you paid for it or not yet. But when you calculate the net income at the end of the income statement, you cannot say this is our cash profit or this is the income in form of cash which we have generated, because for some of the revenues or most of the revenues you have not collected the cash yet. For some of the expenses you have not paid the cash yet. So how can you say that the net income is a cash net income, right? So in order to see that how much cash is generated from the operating activities, or because income statement shows your operations, so if you want to see how much cash was generated through these operations, you have to prepare the statement of cash flow. And in the statement of cash flow, the first section is how much cash is provided by the operating activity, or how much cash is used by the operating activities. So if you prepare the cash flow statement, then you will be able to differentiate between the net income, which is based on accruals, and the cash based net income, which is based on the cash flow statement. Also, cash flow statement has two more parts. One part is operating activity, which I already told you that how much cash is generated by your operations. Then another category is investments, When the company has money, or company invests in long-term assets for a longer period of time, we check that how much cash is used for those investments, or how much cash was provided by these investments. So basically, the long-term assets are considered as investing as activities. And then comes the financing activities, the sources of finance, from where you get the money. So the sources of finance in the companies are long-term liabilities and owner's equity section. Equity also provides you the money. So basically, cash flow statement, it summarizes the cash activities from your income statement, the cash activities from the balance sheet long-term assets, and cash investments from the balance sheet long-term liabilities and equity. So this is how the cash flow statements helps the companies. So in cash flow statement, we have 3 categories. First, always the first section comes first, that is cash flow from operating activities, then comes investing activities, then comes financing activities. In order to prepare the cash flow statement, we need income statement and we need balance sheet. Now the balance sheet has current assets and it also have long-term or non-current assets. On the other side, it has current liabilities. I will write current or it has long-term liabilities and it has equity. Right, this is how the sections of your balance sheet looks like. Now when you prepare the operating activity section of the cash flow, you operating means operations. Income statement tells you what operations you have performed during the year. So you took out the cash based operations from this income statement. So that income statement helps you in preparing the operating activity section. So whole income statement or some parts of the income statement helps you in preparing operating activities. If let's suppose you are preparing the cash based operating activities and you want to see that how much cash revenues we have during the year, income statement will have revenues, but they are cash and non-cash both. Right? So if you want to see that how much cash revenues are there, you need to check accounts receivable, because if the revenue was non-cash, you did not collected the cash for it, it will be in accounts receivable that you have to collect it. So accounts receivable are in current assets. So for the operating activity section, current assets also helps. I gave you the example of accounts receivable. There are many other current assets like inventory. It helps us in calculating the cost of goods sold, and then we have some other receivables. So all the current assets, they help us in preparing operating activity section. Also, if I want to see in income statement which are my cash basis expenses and which expenses are non-cash, so I need to check my payables, right? Accounts payable or salaries payable or interest payable or rent payable, all these are my current liabilities. So current liabilities also helps me in preparing the operating activity section. So in order to prepare the operating activities, you need income statement, you need current assets, and you also need current liabilities. Then comes investments. Investments are for longer period of time, and non-current assets are for longer period of time. Right? Non-current assets includes property, plant and equipment, PPE. It includes long-term investments in bonds and stocks, and it also includes intangible assets. So all of them. who used the money, who gives you money during the year, who provided the money, who have used the money. All these things will be reported in investing activity section. So can you see here, changing in investment and long-term asset items, they are investing activities. Then comes financing activities. Financing activities, the sources of finance, longer period of time. So long-term liabilities and equity are the sources of finance. You issue notes, you get money. You issue bonds, you get money. You issue shares, you get money. You give dividend, money goes from your hand because of the equity holders. You pay back the bonds payable, so you pay the money to the finance holder. So these things, long-term liabilities and equity, they help you in preparing the third section of cash flow statement, which is known as financing activities. So you will be looking into the long-term liabilities and stockholder equity section. So in this way you divide these two statements. But sometimes, because the statements have hidden information for which calculations are not very clear to us, so we need some additional information as well. So I will be showing you in the examples, then the things will be more clear to you that what does additional information means. So basically your classification of cash flow means how many sections of the cash flow you have. You have firstly the operating activity section. Mostly the income statement items are helping you, but for support you need current assets and current liabilities as well. If you are using, now let me tell you, there are two methods to prepare the cash flow statement. One method is known as direct method and the other method is known as indirect method. Okay, this example of operating activities preparation is for direct method. Understand this concept, but practically we will be applying, numerically we will be applying indirect method. Okay, so right now this presentation is for direct method. Number one, you will firstly prepare the operating activity section. Under both method, operating activity section comes first. All the cash inflows, which activities gives you money from operations, inflows. So you do sales, you get money, right? So from the sales of goods and services, so only cash based sales you will be considering. Then if you have investments in the stocks of other companies, you will be receiving the dividends. If you have given the loan to someone, you will be receiving interest on that. So these two things provides you inflow, they brings the money for your business, so we call them as cash inflow. Cash outflow, for which things you pay the money for your operations. So you pay for inventory, you pay for wages, you pay for taxes, interest, and for other expenses. So all the cash based expenses will be outflows for you. So inflows and outflows, you write them like this in direct method, the first method. This is the only section of cash flow statement which is different under both methods. The rest two sections, which are investing activity and financing activity, they are the same in both methods. So let's check the investing activity. As I mentioned in the beginning, non-current assets helps you in preparing the investing activity section. So when you inflows comes when you sell your investments, when you sell your property, plant and equipment, then you get the money. Inflows comes. So from the sale of property, plant and equipment, you get money. From the sale of investments, those investments you did in debt or equity of other companies, you get the money. If you have given the loan to someone, when that loan comes back, you collect the principal, you get the money. Outflow, opposite of inflows. When you purchase property, plant and equipment, when you purchase investment, when you give the loan to someone, all these things takes the money from you, so they are outflows. Let's move back let's move forward towards the third section of the cash flow, which is financing activities, long-term liabilities and stockholders equity. Long-term liabilities includes all those liabilities which are for longer period of time. So inflow, whenever you issue the loans, for example, issuance of the bonds or notes brings the money for you, so that's an inflow. When you issue the common stock or preferred stock, that's an inflow. Cash outflow, when you give the dividend to the stockholders, when you pay back the money of the bondholders or the notes payable, and when you purchase the treasury share, right? So all these things takes out the money from your business. So in this way you will be preparing investing and financing activity section. Do remember, during the year, companies also have sometimes non-cash activities. Like let's suppose in previous topics we have discussed that company has purchased a land and issue the bonds for it. Bonds payable gets credit. Or company has purchased a building and issued the common stock for it. So if you see this journal entry, debit and credit does not include cash. Land will increase, bonds payable will increase, but there is no cash. Building will increase, common stock will increase, but there is no cash. Right? So such activities, they are not the part inside the cash flow statement. They become a note in the cash flow statement. So what are the significant non-cash activities? Let's suppose you directly issue the common stock to purchase an asset like building, or you are converting the bonds into the common stock, so bonds gets debit, common stock gets credit. Or you purchase an asset and you issue the debt, so like this example, bonds payable gets credit. Or you purchase one, you actually exchange one asset with someone. You take their asset and they take your asset, non-cash, right? So companies, it's important that when you are preparing the cash flow statement, in notes to cash flow statement or at the bottom of the cash flow statement, separately you mention that these are non-cash activities. So do remember, we cannot ignore them, but yes, we have to significantly mention because they are of big amount. So we have to mention them that these activities happen, but they were non-cash. So let's proceed towards different formats of the cash flow or methods of the cash flow statement. As I said, we have direct and indirect method. Both methods have three sections, three types of activities, and the difference between both methods is only in the operating activity section. The template which I gave you before, that was for direct method. Let's check how the format of the cash flow statement looks like. So if you see here, we will be writing the name of the company, then we will be writing the statement of cash flows for the period, for the year ended, for the period ended, just like income statement and retained earnings statement. It's not as on, it's for whole year, right? That's why for the period ended. Cash flow, firstly the operating activity will come, so you have to write exactly the same, cash flow from operating activities. Then all the items you will list who brings the money through operations or who takes the money in operations, and then you will net them off and you will put them outside here in the outer column, saying that if the answer is positive, you will say net cash provided by operating activity. If the answer is negative, means more cash is used, you will be saying net cash used by operating activities. Then comes investing activity section. So all the inflows and outflows of investing activities you will mention, make a total in outer. Then financing, make a total in outer, and then add these three, operating, investing and financing. That will give you an answer that how much cash increase or decrease during the year. Then add the opening balance of the cash into it, and then you will get the ending balance of the cash. And remember, I said non-cash activity at the bottom of the cash flow statement, so list all of non-cash activities at the end. What are the things? Learning objective number 2 will be preparing the cash flow statement using indirect method. So what do you need? You need comparative balance sheet. Comparative balance sheet means 2 years balance sheet. If you want to prepare the cash flow statement for 2023 year, you need the balance sheet of 2023 and 2022 last year. You need current year income statement, so 2023 income statement, and some additional information to make some hidden facts clear. So 3 steps you will be using to prepare the statement of cash flow using indirect method. Number 1, firstly you will be calculating the operating activity section. How you will do that? You will start from the net income, pick up the net income from the income statement and adjust it, because it's an accrual based net income, because in income statement everything is accrued, right? Accruals are also taken, cash is also taken. So you will be converting the net income to the cash based net income. And how you're going to do that? You're going to do this with the help of current year income statement. Also you need some data from the balance sheet, and I made it very clear in the beginning that for operating activity section you need current assets and current liabilities from the balance sheet, right? So income statement, current assets and current liabilities will help you in preparing the cash flow statement operating activity section. Step number 3, analyze non-current assets. Why non-current assets? Because they help us in making investing activities, and liabilities, they help us in creating financing activity so that you can make investing and financing activity. Also, by studying them and by reading the notes to financial statement, you will be able to identify which are the non-cash transaction. So in this step you will be comparing the balance sheet, long-term assets, long-term liabilities and equity balance sheet, and selected additional information which you need. Step number 3, now you are done with operating, investing and financing activity in the first 2 steps, and then you will make a total for them. I showed you in the previous template, right? So when you make a total for them, so you have operating activities total, investing activities and financing activities, add them. You will find out how much change in the cash happened during the year. So compare this change with your balance sheet. You already have a balance sheet. Check the difference between opening and ending balance of the cash to find out that this answer is correct with this difference. So compare the net change in the cash on the statement of cash flow. Compare this in the statement of cash flow with the change in cash account reported in the balance sheet with the change in cash account reported in the balance sheet last year, current year, and then the difference between the beginning and ending balance can be easily computed by a comparative balance sheet. So it should be equal to what you find out here as an answer. So why the indirect method is preferred over the direct method? Because it's easier and it's less costly, and it make it very clear why net income is different than from cash flow from operating activities, because all the items are mentioned which are non-cash. So in order to prepare the cash flow statement with the help of indirect method, we have income statement and we also have the balance sheet, comparative balance sheet. Can you see 2016 and 17, and we have additional information with us, right? Let's read it out. So I will not come back again and again to this slide. I'll just explain it, and then I expect everyone, when you are listening, you have this balance sheet and income statement with you for the comparison purpose. Computer service company income statement, current year income statement. So what is current year? 2017. It means we need to prepare the cash flow statement for 2017. We have sales revenue. You know that how income statement looks like, all the expenses and then tax and then net income. Then you have comparative balance sheet. These changes you have to calculate, they will not be given. Comparative balance sheet means you have last year and current year balance sheet with you. All the assets are here and the liabilities are on the next slide. okay, and then also the equity is here, and then this is the additional information. Let's quickly see what you're going to do. Step number 1, quickly check which asset or which liability is increasing or decreasing with what amount. So you'll be calculating this last column now. 2016 cash was 33, 2017 cash is 55, so the difference is 22,000. There is an increase. Accounts receivable 16 to 30,000, 2017 20,000, it is decreasing 10,000. Inventory is increasing, prepaid expenses are increasing, land is increasing 110,000, building is also increasing 120,000, accumulated depreciation on building is also increasing 6,000, equipment is also increasing 17,000, and accumulated depreciation on equipment is also increasing with 2,000. Liabilities, accounts payable are increasing, income tax is decreasing, bonds payable are also increasing with 110,000, stock is increasing, retained earnings are also increasing. Let's read out the additional information. Depreciation expense. What is the depreciation expense? Go to the income statement. Depreciation expense was 9,000, right? They say this 9,000 comprises of 6,000 for the building and 3,000 for the equipment. Okay, 6,000 for the building. Can you see here? This is building. Accumulated depreciation 6,000 increase, and the equipment 2,000 increase, but do remember they said 3,000. I will tell you why it is like that. Okay, just remember for a few minutes. I'll make it very clear in a while. Okay, so but we know that how much is depreciation expense. Company sold the equipment with a book value of 7,000. What is book value? Book value is equal to cost minus accumulated depreciation. So cost was 8,000, accumulated depreciation was 1,000 for this equipment, and company sold it. So this is the 1,000 which is already out of the balance sheet because it was sold. So that's why the difference is 2,000. 1,000 is already sold out, so that's why together it's 3,000. Okay, but you don't need to go in that much deep details because it's just the initial example. So just think that it's company 3,000, and we have very clear picture of depreciation over here 9,000. Okay, issued 110,000 of long-term bonds in direct exchange of land. Go to the balance sheet, check the land, it is increasing with 110,000. Check the long-term bonds, they're also increasing with 110,000. But bond did not bring any money, they brought the land. So this is non-cash investing and financing activity. A building costing 120,000 was purchased for cash. Check long-term assets above in the balance sheet. Building is increasing with 120,000, so it's used your money. Equipment costing 25,000 was also purchased for cash. So you purchased the equipment, you also sold the equipment, right? Issued common stock for 20,000 cash. If you check the balance sheet, common stock is increasing with 20,000 and you get money for that. Company declared and paid 29,000 cash dividend. Now retained earnings, if you see, they are increasing. In few chapters back we prepared the statement of retained earning, and we know that retained earning is affected because of net income and net loss. It is also affected because of dividends, right? Dividend decreases the retained earning, net income increases the retained earning. Net income is the part of your operating activities because it is an income statement. Dividends are the part of owner's equity, because when I tell you that dividends are paid to the common stockholders, and they are paid out of the retained earnings, so they actually affect the retained earnings. So what I wanted to explain you over here, in cash flow statement we do not mention the difference of retained earnings directly. No, we just mention the dividend in the financing activity section with reference to the retained earning. Or in other words, you can say, instead of putting retained earnings, we put net income in operating activity section and dividend in financing activity section. Okay, now we have details of everything. We can move on towards preparing the statement of cash flow. For this part, I said I'm not going to take you back again and again to the question. I expect that please open the balance sheet and income statement in front of you, so that when I'm explaining you can see the numbers. Okay, step number 1. What was step number 1? Calculate the difference between cash flow from operating activities and net income. So see here, determine net cash provided by or used by operating activities by converting net income from accrual basis to the cash basis. So we will take the net income firstly, and then we will do adjustments. Indirect method is very easy, because from income statement at this level, at initial level, you need to take only 3 things, not full income statement. Number 1, you need to take net income as the start of cash flow statement, and you will add back non-cash expenses, which is depreciation or amortization or depletion, anyone, whichever is there in income statement, take it out. So you will take net income and you will add depreciation or amortization into that. Then check income statement and deduct if there is a gain on sale of any asset. Deduct it. Why? I'll give you explanation in a while. And if there was a loss in the income statement, no loss on disposal of assets or investments, add it back. And then go to the balance sheet directly. So only 3 items from the income statement you will be taking: net income, depreciation, amortization, gain or losses, and then directly you will move towards the balance sheet, current assets, and after current assets, current liabilities. So check all the non-cash current assets and the current liabilities to make the adjustments, and in this way you will be preparing your operating activity section. So let's prepare for the same example. Firstly, check the income statement. Your net income, last item of the income statement, is 145,000. So we start the cash flow statement by writing cash flow from operating activities, net income 145,000. Then this statement we write always, because now we are going to adjust this net income to the cash base net income, which is cash flow from operating activities. So what you do, first step I told you just in the previous slide, add back depreciation, amortization or depletion. We have only depreciation expense of 9,000, so we add it back. If nothing else is there, we will just say this is net cash provided by operating activities. Why? Because answer is positive. This is inflow, this is also inflow, because we firstly minus it, now we are going to add it back, right? But this is not it, we have many other things. So second thing is loss on disposal of equipment. Why we write the title loss? Because in income statement, if you see, there is loss, but in other balance sheets or in other companies, you can have gains as well. So we will discuss both of them now. Companies report as a source of cash in investing activity section the actual amount of received. So for example, the book value of equipment in this question is 7,000. Check the additional notes. Book value is 7,000, right? And you sold this equipment for how much? You received the cash of 4,000. Check notes again. You have, they said that it was sold for cash 4,000. So you have net answer is 3,000. This is the money you get by selling this equipment. In income statement, you have loss on disposal of equipment. Check your income statement. there is a loss on disposal of equipment. That is decreasing your income, right? Because you are subtracting it in income statement. But the net effect you will be putting in investing activity section. So if you do not remove this loss from the net income, the effect will be dual. Here in income, in operating activity section, the loss will be there, and in investing activity section, the loss will also be there because you adjust it and put the net amount. So in order to remove the dual effect, you add back the loss to the net income so that its effect is removed from the operating activity section. So company report as a source of cash in investing activity section. This will go to investing activity section, the actual amount of cash received. So any loss on disposal is added to the net income in the operating activity section so that its effect is removed from the operating activity. Why? Because it will go in financing, in investing. And for example, if you have gain, so gain increases the net income, but the net amount will be mentioned in investing activity section. So remove its effect from the operating activity just to remove the duplication. So that's why gains are subtracted or deducted from the net income. So if you see here, check you in income statement, you have loss on disposal of equipment. So I said loss will be added back. So net income, add back depreciation, add back loss. If nothing else is there, this will be cash provided by your operating activity. But this isn't it. We have many other things. We need to go to the current assets section, right? I said in income statement, you just need these three things, right? Now we will move towards the current assets section. In current assets section, first current asset is accounts receivable. If you see account receivable opening balance, check the balance sheet. Last year it was 30,000. This year you have 20,000, right? So how much change is happening? That is 10,000. It is decreasing. Why? Because you collected the money from them. Okay, so that's why they say when the accounts receivable balance decreases, cash receipts are higher than the revenue earned under the accrual basis. So it means that you not only collected the money from the sales revenue, but you also collected the money from your previous year accounts receivable, which were because of the sales revenue. So sales revenue not only for this year plus also the previous year brings the money for you. So when accounts receivable decreases, it brings the money for you. So can you see here, opening balance was 30,000. Current year, these are accounts receivable. Accounts receivable get debit because of current year sales, 507,000. I get it from income statement. But you collected the money from the customers. How do I know? Because ending balance is 20,000. 30 plus 507,000 should be 537,000, but I have 20,000. So where the remaining balance go? We collect the money from accounts receivable. That's why they decreased. So this is just for explanation. In order to avoid the confusion, just check the opening and the ending balance of accounts receivable. If accounts receivable are decreasing, it means that you collected the money from them. So add it into your cash flow operating activity section. If accounts receivable are increasing, it means that current year sales does not bring the money for you. So reduce minus the increase from the income statement. So if accounts receivable decrease, add. If accounts receivable increase, minus. Okay, so company add net income, the company adds to net income the amount of decrease in accounts receivable. Why? Because they also gives us money. So now what changes will happen? If you see here, I added the decrease in accounts receivable. But you know that this is not it. We have many more current assets. So let's go to the next current asset, which is inventory. When the inventory balance increases, the cost of merchandise purchase exceeds the cost of goods sold. See, if you purchase the inventory and you sell it, you will get cost of goods sold. Right? So it means that whatever money you paid for inventory, that was transferred to the cost of goods sold, which is an expense. But what if you have ending inventory increase? It means that all the inventory is not sold out. So you paid for inventory not only for one which is sold out, but also for the additional inventory which is in your ending balance. So when the inventory balance increases, it means that the cost of inventory or merchandise purchased is more than the cost of goods sold. That's why this increase shows the spending of money. You purchase the inventory, you spend the money. So that's why you minus it, because money goes from your hand. So cost of goods sold does not reflect cash payment made for the merchandise. Why? Because you paid for the cost of goods sold plus also that inventory which is increasing in your ending balance. So you paid cash for both. So this outflow is already there in the income statement, but addition to the inventory is not there. So that should also be minus. So company deduct from the net income this inventory increase. So when inventory increase, we minus it. When inventory decrease, we add it. So now because inventory was increasing, we minus it. Let's move on towards the prepaid expenses. Prepaid expenses balance is also increasing. Why prepaid expenses increases? Because you paid for the future year expenses as well. Prepaid rent, remember? Prepaid insurance, remember? You paid in advance. So in your income statement you might have insurance expense, but that's not the full. You also paid for additional. So that additional which is in prepaid, now minus it from net income because you also paid for it. So when the prepaid expenses increases, cash paid for the expenses is higher than the expenses reported on accrual. So that's why company deduct the decrease from the net income to arrive at the net cash provided by operating activities. So if the prepaid expenses decrease, reported expenses are higher than the expenses paid. So remember, prepaid expenses means which is another asset. When it decrease, we add it. When it increase, we minus it. So because it was increasing, so we minus it. Let's move on towards the current liabilities. In current liabilities, two current liabilities are there. We have accounts payable and we have income taxes payable. Accounts payable were increasing. It means that current year expenses, you did not pay the money for them. So when the accounts payable increases, you add them back because expenses which are subtracted from your income statement, you did not pay for them. Like let's suppose an example, you have salaries expense in income statement. In current liabilities, you have salary payable. Okay, it means that for this expense you did not pay the cash. So why this expense is decreasing your net income? So when the liability is increasing, add it back because it shows that this expense was non-cash. So same is the case here. Accounts payable, they increase. The company received more goods than actually it paid for. Means the goods were on credit basis. You did not pay for them. So that's why you're going to increase. You're going to add it to your net income so that you actually know what is cash provided by operating activities. And income tax payable, it decreases. It means that for the last year income tax expense you also paid. So you not only paid for current year income tax expense, you also paid for the last year income tax expense. So that's why you need to minus it. So when the income tax expense reported on the income statement was less than the amount of tax paid during the year, the decrease in the income tax payable is subtracted so that we have actual balance of cash flow from the operating activities. So when liability increase, we add it. When liability decrease, we minus it. So we did both of them, and then finally we have net cash provided by operating activities. So now I told you many things, how you're gonna remember them. So I'll give you a basic rule to remember these things. Number one, take the net income, add back depreciation, amortization and depletion if they are. If one of them is there, add it. If two of them is there, add it. So if all of them, add them. Then go to the gain or losses. in income statement, check, do you have gain or do you have loss? If you have gain on disposal of asset, you are going to minus it from your net income. If you have loss on disposal of asset, you're going to add it. Then current assets and current liabilities. If your current assets are increasing, you're going to minus them. If they are decreasing, you're going to add them. If the liabilities are increasing, you're going to add them. If the liabilities are decreasing, you're going to minus them. So assets behave opposite. Asset increase, opposite will be action, minus it. Asset decrease, what will be the opposite action? Add it. Liability is the same direction. Liability increase, add it. Liability decrease, minus it. Okay, so like this you can remember. Let's do it exercise. Josh Photo Plus reported net income of 73,000 for 2017 included. So this is the net income they gave us. In the income statement, we have depreciation expense of 7,000 and there was a gain on disposal of equipment 2,500. They took following information from the comparative balance sheet. In 2016, accounts receivable were 17,000. In 2017, 21,000. So there is an increase of 4,000. Accounts payable were 6,000. Now they decreased to 2,200. So there was a decrease in accounts payable. How much? It's 3,800, I guess. They want us to calculate the cash flow provided by operating activities. So let's prepare it. Cash flow from operating activities, net income. Adjustment to reconcile the net income to cash provided by the operating activities. Firstly, depreciation. Then we have a gain. So gain is subtracted, right? So gain on disposal of equipment, minus. Increase in accounts receivable, minus. Decrease in accounts payable, minus. This was the rule, right? You net them, so you have 3,300 minus, but 73,000 minus 3,300, you have 69,700 cash flow from operating activities. Let's move on towards the second step of preparing the cash flow statement, that is investing and financing activities. So in the balance sheet, go back to the balance sheet, check, you have land, and land is increasing with 110,000. But as I was reading the notes for you, I told you land was purchased by issuing the bonds. So this is a non-cash activity, right? So land is increasing, but this is because of the bonds. So non-cash investing and financing activity, so you have to put it in the disclosure. Can you see? This is the disclosure, issuance of bonds. At the end we put it. Okay, I did not discuss any of these with you, but just wanted to show you, that's why. And previously we prepared till here. 172 was the answer, was net cash provided by operating activities, right? Then we have building. If you check, building is increasing with 120,000. In notes, additional information, they said it was purchased for cash. It means that cash goes from your hands, right? So increase, again, building is an asset. Asset is increasing, you will minus. Exactly the same behavior like current asset. So if you see here, purchase of building 120,000, you are mentioning with minus sign. Then moving on towards equipment. Equipment has two notes. If you check, first note says you have sold the equipment for 3,000 and the 4,000, and the other says that you have purchased the equipment for 25,000, right? So two transactions are happening. Purchase of equipment is happening, at the same time the sale of equipment. This was the value of equipment and you sold it for 4,000. So net value you are going to put in your investing activity section. So two transactions will come for the equipment. Firstly, purchase of equipment 25,000, it's an outflow, but you also sold the equipment, so inflow 4,000. Then after that we don't have any non-current assets, so we will go to the balance sheet liability section. There is only bonds payable in the long-term liability, and we already know that's non-cash, so we cannot take it. After that, move towards the equity section, and we have common stock and it is increasing with 20,000, and we already said in notes it's clearly mentioned that it's for cash. So because when you issue the shares you get money, so it's an inflow. So when liability or equity increases, we add it. And then in notes they said that the dividend was paid for 29,000. Remember, for retained earning I said we mentioned dividend in the financing activity section. So 29,000 cash dividend, so it will go out of your hands, so payment of cash dividend. So when you net these two, you have 9,000 outflow. Operating activity gives you inflow, investing activity gives you outflow, and financing activity also uses the outflow, but we have to add, right? So 172,000 plus, but we have minus bracket, right? 141,000, then plus, but we have minus 9,000, right? So plus minus minus, this is 9,000. So plus minus, so 172,000 minus 141,000 minus 9,000, so you get 22,000 net increase in the cash. Now you have to match it with the difference between opening and ending balance of cash. Check your balance sheet. Your opening balance of cash is 33,000 in 2016, and in 2017, which is ending balance, that's 55,000. Take a difference. So the difference between these two is 22,000, which is exactly what you get over here. Then add the opening balance into it. Opening balance means last year balance, and you will get the ending balance of the cash. So in this way you prepare your cash flow statement. The last learning objective is a basic analysis for the cash flow statement, which is known as free cash flow. Free cash flow means how much cash is free after doing the necessary expenditures or necessary spendings. So the main source of providing the cash is the operations of the company. If the operations are efficient, good amount of cash company would be collecting. So free cash flow is basically your net cash provided by operating activities. Where is it? The first section answer, this one. Minus, you need this money for the capital expenditures purpose. Capital expenditures are must expenditure which you need to do in your property, plant and equipment, because if you will not do, you will not have machinery or plant and you cannot produce, and if you cannot produce the product, how you will run the operations? So this is necessary expenditure known as capital expenditures. And then of course you have to pay the cash dividend to the shareholders, so minus cash dividend. So after this full money which you receive from operations, you spend on capital expenditures, which is only property, plant and equipment, and you pay the dividend. So remaining is your free cash flow. If you see here, I have an example for you. This is Microsoft Corporation, their statement of cash flow. We have operating activities 21,863. So I need to calculate free cash flow. So operating activity cash flow minus capital expenditures. So there, can you see how much capital expenditures? 4,257. This is the money you need. Don't consider investment. Investments are by choice. If you have money, you will invest. If you don't have money, you will not buy the shares of other companies. But property, plant and equipment, you cannot compromise on it. You need them. So this is mandatory capital expenditure. And then check here, this is actually the selected information, this is not the full information. Okay, so here this is the dividend 7,455. So remaining cash is free. Out of 21,863, you will spend 4,000 for the capital expenditure, 7,455 for dividend, rest is free cash flow. So this is it about the discussion of cash flow statement. I hope I tried my best to make it clear to you, but still, if some points are confusing you, I will advise you first listen to the recording of your exercises relevant to the cash flow statement, because once you do the steps again and again, the things gets more clear to you. After doing that, if you still have some questions, you are welcome to write in the comment section and I'll try my best to answer on time. Take care everyone. See you soon with the next video.